Everyone come back please. Okay, so whoever is there, let's start. So in the notebooks, write down module 3. In the notebooks, write down module 3. And give heading calculation of current market price by discounting future cash inflows at the rate YTM. Calculation of current market price by discounting future cash inflows at the rate YTM. Please give heading in the notebooks. Thank you. Everyone ready? Okay. Now keep your pens down. I have to explain this to you. See, I am writing bond details. Let's say face value is ₹1000, coupon rate 10%, life 5 years, redemption value par, YTM 12%. Okay, YTM 12%. Now, ready, everybody will start. Now, they ask you calculate current market price of bond. Now, this is strange because how can we calculate current market price? What we can calculate is the value. I hope you are able to understand what I am saying. Price, can I say, is a demand supply function. Everyone ready now? Price is a demand supply function. Value is what we can do. Now value is what we can calculate. Are you ready? But now I will tell you, no, we can calculate price also. As of now, as of today's price, we can calculate. How? Current market price is equal to present value of all future cash inflows discounted at the rate YTM. Okay, so that means, sir, same what we did in module number 1, same thing we have to do. Yes, in module 1 also you did this only. You took the future cash inflows and you discounted them. Here what you are doing, same thing, you are taking future cash inflows, discounting them. What is the difference? The difference is, in module 1, the rate at which you were discounting was the required rate of return, and in module 3, the rate at which you are discounting is the IRR, the YTM, the actual rate of return. Are you listening? We are discounting at the rate YTM. That is the only change. Now I'll write here cash inflow discounting factor at the rate 12% present value. Now for 5 years, can I say 1000 into 100, 1000 into 10%, 100 rupees coupon you will get. 5th year, 1000 rupees redemption value, 3.605, 0.57. What is the discounting factor? 567. Just check once. 567, and this is 360.5, this is 567, this is what, from 7 to 8, 927.5. okay, now listen carefully. This is not V bracket B. Are you all there? This is not V bracket B. This is CMP. Are you all there? This is CMP. So what did you understand as a rule? If future cash inflows are discounted at the rate required return, then PV of CI that you get is the value of the bond. This is basically module 1. And if future cash inflows are discounted at the rate actual return meaning YTM, then the present value of cash inflows that you get is the current market price. Everyone ready? Is the current market price, and this is basically module number 3. All clear? But then one can ask that, sir, how? Understood question? How, in a sense, or you might say why? How is it possible that we understood module 1 logic? In module 3 logic we are not understanding, because in module 3 we understood how to do it. That is clear, very simple. I hope you realize calculation wise module 1 and module 3 are same only. The only difference is conceptually you are taking a different discounting rate. In the first module you took a discounting rate which was your required return, and the present value you got was the theoretical valuation. But now in module 3 you are taking not the required return, you are taking the actual return, the IRR, the YTM you are taking. That much you all understood. But then how is it possible that by discounting at YTM we are getting this number? Everyone ready? That is a question. So how is it current market price? How do we trust that this price is CMP? That is the question. Everyone ready? No? Can I start? Okay. So the logic is like this. Students, do you realize at the rate YTM or at the rate IRR, do you understand, all of you, that net present value will come to 0? Come on. You understood this, what I am writing here? If I discount cash flows at the rate YTM or IRR, NPV equal to 0. Sandeep, clear na? Kusuma, understood? Riddhi, clear? Net present value equal to 0. Okay. Now, for NPV to be 0, can I say present value of cash inflows should be equal to present value of cash outflows? Are you all agreeing? Present value of cash inflow should be equal to present value of cash outflows. Students, what is present value of cash outflow for a bond? It is the initial investment into one. Do you agree? In year 0, na? In year 0 we write I, initial investment, and I hope you all know that initial investment is nothing but the current market price. Come on everyone. For a bond, the initial investment is the current market price. Everyone clear? So I hope you realize, if I discount future cash inflows at the rate YTM, then the present value of cash inflows I will get done is equal to CMP. Everyone following? Is equal to current market price. This is the logic, which means NPV will be 0. I hope you're getting it. Huh? Hello. See, listen. I take future cash inflows from a bond and I discount them at the rate YTM. When I discount them at the rate YTM, I get present value of cash inflow, correct? This present value of cash inflow, can I say, is same as present value of cash outflow, because if I have discounted at the rate IRR or YTM, NPV will be zero, no? I hope you're understanding. NPV will be zero. Kusuma understanding, no? Raghunandan clear? Right? Mohammed understood, no? Till here? Divya clear? So when I take future cash flows, discount them at the rate YTM, IRR, then the PV of CI will get will be same as the PV of CO, because the NPV will be zero. And what is PV of CO? PV of CO is the current market price, which means this PV of CI that I got will also be equal to current market price. No, everyone, are you all able to understand? It will be same as PV of CO. NPV will be zero. Same thing I have written here in front of you in 4 lines. Everyone clear? But when those same future cash flows are discounted not at the rate IRR but at the rate required return, then NPV can either be positive or negative. Do you understand? Then the PV of CI is not CMP, it is the theoretical valuation. Required return. Everyone clear, no? But actual return, if you are discounting, then you get CMP. That is the whole point. All done? Clear? Okay. So do one thing. Yeah. Module 3 heading, read again, read. Are you understanding what is the name of the module? Huh? And then I think if you write down this example and all this and also the logic, I think it will become very, clear now in the notebooks. It will become very clear, right? Okay, please start. Krishna, no. All done? Come to question number 27. Okay. This company is planning to issue a debenture series on the following terms. Face value 100, 10 years life. Now, yearly coupon rate, what they are saying? They are saying for first 4 years, 9% per annum. Next 4 years, 10% per annum. Last 2 years, 14% per annum. Current market rate on similar debentures is 15% per annum. The company proposes to price the debenture in such a way that can give 16% return to the investors. The company also proposes to redeem the debentures at 5% premium on maturity. Determine the issue price of the debentures. Ready? Determine the issue price of the debentures. Now, what is the story? I am a company and you are the investors. I am wanting to issue a debenture to you over a 10-year life. First 4 years you'll get 9%, next 4 years you'll get 10%, last 2 years you'll get 14%. Now, the question is, at what price should I price it? What should be the issue price? Can I say whatever price I will price it, that will become your market price? Everybody clear? It will be the price at which you have to actually buy that particular debenture. Everyone clear? Now, this line given here says that if you, the investors, invest outside, somewhere, you will get a yield of 15%. Everyone clear? You will get a yield of 15%. But if I want to attract you, your money, do you realize I need to give you a YTM slightly more than 15, otherwise you will not come to me. Everyone ready? So I am planning to give you how much percent? 16. Now when I am saying 16, I am talking of YTM and not coupon. No? Coupon rates are here. I hope you are listening. Coupon rates are here. But I want to give you a return which is 16%. Now some of you might feel confused and some of you might understand that, sir, how is it possible that if you are giving us a coupon of 9%, 10% and 14%, how is it possible that we will generate YTM of 16%? Understood question? Very simple, na? I will issue the debenture at a discount and I will redeem it at par. I hope you are able to understand. See, if I issue the debenture at 100 and redemption is also at 100, then can I say you will not earn anything above coupon rate? We have discussed this earlier. I hope you are understanding. But if I give you little bit capital gains also, then do you realize that you will be overall able to generate more than the coupon also? Everyone following? No? Hello? Okay. Now the question is, how should I determine that issue price at which I should issue the debenture to you? Very simple. I want to ensure that your YTM should be 16%. No. So what I should do? I should take these future cash flows and discount them at the rate 16%. I hope you're understanding. By discounting them at the rate 16%, whatever will be the present value will become the current market price. I hope you're understanding. And that current market price, at that price, if you buy that debenture and hold it till maturity, you will get 16%. I hope you're getting it. Hello, everyone following? So the end of the day, the whole theme is take the future. Do you realize the 15% data given is useless and irrelevant? Everyone clear? It is just given that okay, outside you're getting 15, but I have to give you 16. For me to give you 16, your YTM should be 16. For your YTM should be 16. What should be the current market price? Simple. Take the future cash flows and discount them at the rate YTM. Everyone clear? Okay. So write down in notebooks question number 27. Question number 27. Write down YTM to be offered equal to 16%. Calculation of issue price slash, okay, no, not slash, calculation of issue price that ensures investors get a YTM of 16%. Next line, issue price equal to PV of all future cash inflows at the rate 16%. Year cash inflow DF at the rate 16% present value. Now tell me in year what all will you do? 100 rupees is the face value. So for the first 4 years, look at the screen once. For the first 4 years, 9 rupees per annum you will get. Next 4 years, 10 rupees per annum you will get, and last 2 years 14 rupees per annum you will get. Everyone clear? And then in the 10th year, redemption also you will get at 5% premium. Students, everybody following now what I'm doing? Hello, 105. Generally it is like this, 1 to 10 and 10. You're understanding? Generally it is like this because the coupon rates are same, but now because coupon rates are different, I had to break it up. Everyone clear? Okay, so now I'll first of all take the discounting factors. And oh, great students, don't write 1 year. Hello, be careful. This is not year 0. Okay, so I'll write 1, I'll type 1 divided by 1.16. 1, 2, 3, 4. This comes to 2.798. 2.798. Correct? Hey, now how do I do 5, 6, 7, 8? I can't use GT. I'll have to use M plus MRC. You're understanding? No? I'll have to use M plus MRC. So 1 divided by 1.16, I'll press equal to 4 times. So I get 0.5522. Till here I don't want, correct? I want 5th year onwards. So equal to M plus, equal to M plus, equal to M plus, equal to M plus MRC. I got 1.545. Please check you got this number. 1.545. 5th, 6th, 7th, 8th. Done. Then 9 and 10. 1 divided by 1.16. 1, 2, 3, 4, 5, 6, 7, 8. Till 8 I don't want. Then 9th M plus 10th M plus MRC. 0.490 I'll do. 4896 na, so 490, is it right? 4896, 490. Oops, I missed the 10th one. Again I'll have to do 1 divided by 1.16. 1 2 3 4 5 6 7 8 9 10. 0.227. This will give you the issue price. 9 into 2.798. 25.18. 15.45. 6.86. In the last year, why it is not 100? Why it is 105? 5% premium they are saying, no, they will give you at redemption. You understood, na, that? Okay. Someone please confirm if you're getting this number. Thank you. Everyone done? Okay. 27th question is over. Now we will go to 11th. Question number 11. Oh yes, slightly tricky. Just read and then wait for me. Just read and keep. There are two exclusive bonds. They are not combined. They are two separate bonds. So they are saying 10% Government of India bond of 100 rupees is currently quoted at 110, but market interest rate is expected to go up by 1%. Okay. Now students, just relax, keep your pens down and just listen to the story. Okay. Question 11. Point number 1. Here I am writing note. Life of bond is not given. Think what I have written. Are you all able to understand? Check. The Government of India bond, they have not given what is the life, na? So then what to do? What to assume life to be? What do you think you will do in the exam? Yes. Yes. Perpetual. Everybody clear? Therefore, we assume the bond to be perpetual. Everyone ready? Okay. Note. Here, YTM, can I say, will be equal to current yield? I hope you remember. Just before the break I taught you now, when there is no maturity, show some maturity. Huh? When there is no maturity, do you realize how can you calculate yield to maturity? Not possible, correct? Okay. Note. ICAI refers to YTM sometimes as market interest rates. Okay. So if you see in that question, point number 1, they have told you na market interest rates. That is basically YTM. Everyone clear till here? Now, okay, I'll write here, or I might use the word currently, YTM of this bond, do you realize will be the, see, YTM means current yield. What is the formula of current yield? Interest upon current market price into 100. Can I say the interest is 10% of 100, which is equal to rupees 10, and the current market price is 110. Everyone clear? So this will be interest upon current market price into 100, 10 upon 110 into 100, which is equal to 9.09%. Everyone clear? 9.09%. Now what are they saying? They are saying that this YTM is expected to go up by 1%. If it is expected to go up by 1%, can I say expected YTM will be 9.09% plus 1%, that is 10.09%. Everyone clear? The YTM has changed to 10.09. Then if this changes, what is the market price of the bond? Students, can I say calculation of expected, or I might use the word revised current market price. You know that current market price is present value of all future cash inflows discounted at the rate YTM. Everyone clear? Discounted at the rate YTM. Now, as far as, I hope you are able to understand, as far as a perpetual bond is concerned, you cannot make a table and all for calculating the present value. The only option you have is to do interest divided by R. The only changes, earlier in the R I used to take my required return. Now I hope you realize I will be taking the actual return. Everyone clear? Because I am not here wanting to find theoretical value. I want to find the actual price. And therefore the interest, which is 10 rupees, will remain 10 only. YTM, which was 9.09%, has now gone to 10.09%. Can someone tell me what is the price coming to? 10 upon 10.09%. $99.1. Okay, rupees 99.1. All clear? Rupees 99.1. Any doubts? Okay. Now I want to do little bit here. Just want to talk to you something. Calculation understood, na? Everyone clear? Simple. But I want to talk to you something about this. Listen. Let us think about module 2. Everyone please go to module 2. Okay, now for the next 10 minutes, whatever I will say, if you don't understand, forget I ever said it. You're understanding? Doesn't matter. You will still get rank. So right now, please go to module 2. Okay. Now in module 2, at the start, correct, I gave you this information. Now can you see in this information I gave you the current market price, and with that current market price we calculated YTM 10.51 or basically 10.54, whatever. Everyone ready? We got the YTM. Now I want you to listen to me, please. I hope you get it. Students, this is how things work. It is not that YTM is 10.54% because the price is 980. The real explanation is reverse. It is because the YTM is 10.54%. The price is 980. Okay, again. It is not because of the price being 980 that YTM is coming to 10.54. In fact, it is because the YTM is 10.54, the price is 980. What does that mean? That means that Okay, do you understand anyone who buys this bond today at 980 and holds it till maturity will get 10.54% YTM? Correct? Now everyone following what I'm saying? Will get 10.54% YTM. Now, do you all understand that the fact that the price right now is 980 means all the people in India or majority people of India are okay with 980 price? Come on everyone, because if they were not okay with 980 price, then demand supply function would have changed the price. I hope you're able to understand. Right now at this point, see, there will always be a small group who might not, but that small group can never influence the result. Now I hope you're understanding. Right now the price is at 980 means there are buyers majority and sellers majority who are ready to trade at that price. Everyone ready? That is why the price is 980. Correct? If the sellers would have reduced and buyers are demanding more and more and more for this bond, then the price would have gone up. If sellers would have increased and buyers are not so interested in buying, then the price would have come down. The fact that it is at 980 means that buyers and sellers meet each other at 980. This language, you understand? They meet each other at 980. That is how, students, that is exactly how market prices are determined. Everyone ready? The price at which buyers and sellers meet is the market price. Simple. Correct? Everyone following? No? So the market price of apple is rupees 100 per kg, for example. Now if the community would have said no, I am not ready to pay anything above 70, then the apple seller could have never sold apples. You're understanding? If the community as a group, majority, there will be exceptions, but the majority, if they are saying that no, we are ready to pay only 70, then it has to be 70. Correct? Secondly, if the majority are saying, now let's say that some big person comes on television and tells you the importance of apples and tells you if you eat apple then you will become CA, like something like that, for example, or you will do great in life, or you will apple a day doctor away, something like that. Someone tells the society great about apple. Then do you realize there will be a mass demand for apples? Apples will become Lakshadweep Islands, then you're understanding, no? Demand increases. When demand increases, apple seller will not sell it to you at 100, na? Because if people are ready to pay 150, I hope you're understanding. If people are ready to pay 150, seller also will increase the prices and will meet you at 150. Of course, he will do that. Everyone, am I able? You're able to understand what I'm saying? So the price is nothing but a function of which place the buyers and sellers meet. Correct, everyone? Which place they both meet. Now when I go to buy let's say a Reliance share, now let's say Reliance share is trading for rupees 2500. I will go and put my price. I want to buy for 1000 rupees. I can, but can I say no seller will come to me? I hope you're understanding, because there are so many others who are willing to buy at 2500. Now why will he come to me? So because buyers and sellers are meeting at 2500, I am an exception. Then the price will not be influenced by what I am doing. Everyone clear now? The price is influenced by majority. Now Um, so coming to this example, what is the market price? The market price is 980. Now since the market price is 980, why are people suddenly appearing on the screen? Something happened? Suddenly some inflow of people. Hello. Okay. Anyways, so but I did not get the message. Anyways, you all must have got. Okay. Now, so the fact that the price here is rupees 980 means, can I say that buyers and sellers are agreeing at 980? Everyone clear? That means buyers are willing to buy this particular bond at rupees 980. Correct? If the buyers would have said, no, we are ready to maximum pay 950, then do you realize the price had to be 950? Everyone clear? Now, when you listen to my explanation, do you understand the next line that I'm going to say? It's going to be a slightly tricky line, but try understanding. Look at me. What is theoretical value? Theoretical value is what I am ready to max pay. Remember? Hey, do you realize that the theoretical value of the majority becomes the actual value? Take your time. Theoretical value of majority becomes the actual price, meaning what everyone is majorly saying, this is what I am ready to max pay, that only will become the actual price. No, how can things be different from that? Correct? So this 980 might not be individual theoretical value of a particular person, but this 980 is, if it is price, it has to be the theoretical value of the majority. Everyone clear? Sure? Okay. Now the question arises, why is majority wanting 980 to be the price? Understood question? Why is majority saying that we are ready to maximum pay 980? Why is 980 the theoretical value of the majority? Because the majority must be wanting 10.54% from this bond. Come on, think about it. The majority must be wanting 10.54% as the return. The required return of the majority must be 10.54, which means the majority must have taken future cash flows of this bond, discounted them at the rate 10.54%, and they must have got 980, and they must have said, okay, if I want 10.54% maximum, I'm ready to pay 980. And if majority are thinking this only, then can I say 10.54 becomes not required return, it becomes actual return? Everyone clear? 980 does not become theoretical value, it becomes actual price. Come on, everyone following? No? So this, in our calculation, we are given 980 first, and by that we calculate 10.54%. But can I say the reality is different? The reality is people, why is the price 980? Because people wanted 10.54%, like that. Everyone clear? Now, because they wanted 10.54, that is why 980 came. Is it clear till here? Now tell me, what is the relation between R and PV? Inverse. What is the relation between R and PV? Inverse. Okay. Now students, imagine that you purchased this bond at rupees 980. Everyone agreeing? You purchased this bond at rupees 980. Let's say Sandeep purchased this bond at rupees 980 and Tamanna is yet not purchased. Story clear? Sandeep, if you buy this bond at 980 and you hold it till maturity, can I say you will generate 10.54% per annum YTM return, IRR? Correct? Okay. But now what happened now? In the market outside, in the bond market outside, the interest rates fell. Interest rates fell meaning today if Tamanna goes outside and buys some bond, listen to this explanation, please. Ready? If Tamanna goes outside and buys the bond, any other bond, then she will get only 9% return. YTM is only 9 because the market interest rates have fallen. Still your story clear? So Tamanna says, oh no, hey, I will run to this bond which is giving 10.54, correct? I will run to this bond who is giving 10.54%. Why should I go outside and take 9%? Correct? Students, do you realize like that there will be lakhs of tamannas who will come with this tamanna that we want to get 10.54% here. So many people will rush to this bond which Sandeep has. What do you think will happen to the bond? The demand will increase, correct? The demand will increase. Can I say the price of the bond will go up? Ready? The price of the bond will go up. It will go up. It will become expensive. It will go above 980. See children, the coupons and the redemption is not changing. What Tamanna will get is not changing, but what she has to pay will not be same as what Sandeep paid. She has to pay more than 980. Everyone clear now? What our concept is saying, or what I am trying to say through this extra, is that the price of Sandeep's bond will grow beyond 980 to such a level that when Tamanna actually buys this bond, her YTM still will be 9% only. You are understanding? Which means there is no free lunch in the world. You understand? Na? If outside everyone is 9, this also has to be 9. But then someone might say, but Sandeep is earning 10.54. Na? Yes, because at that time when Sandeep entered, the pricing was such that everyone was saying we want 10.54%. So when everyone was saying we want 10.54%, the price that Sandeep got was 980, which is giving him 10.54%. But by the time Tamanna is entering, everyone following now? By the time Tamanna is entering, do you realize everyone is saying we want 9%? Because outside we are getting 9. And due to that, what will happen? The prices would have gone up. Now from mathematical point of view, do you understand maths? As the discounting rate falls from 10.54% to 9%, present value of the bond, that is 980, will start going up. No, that is maths. Demand supply economics, you understood why it is going up. Mathematically you understood why it is going up. It is going up because everyone is saying we will discount future cash flows at 9 because outside we are getting 9. Opportunity cost is 9 only. So if opportunity cost is 9, the discounting of this bond also will happen at 9. And due to that, can I say the prices will go up? Hey, everyone clear? And this will be, so Sandeep, can I say, should not care if the market interest rates are going up and down, because if he hangs on till maturity, he will get his 10.54. I hope you are understanding. Let the prices go up and down, doesn't matter. Sandeep doesn't care. Correct? But if Sandeep midway wants to get out, Sandeep, don't worry. If the rates have gone down outside, the price of the bond that you are holding would have gone up. No, I hope you're understanding. Sandeep will be able to sell it at a higher price. Done. Now I want you to think and tell me. You studied mutual funds now with me, everyone. Do you realize there were some debt funds also? We never spoke about debt funds because you remember my equity funds explanation only went for 3 hours. But if you remember, first lecture, na, all introduction I had given to you. But I told you can research on your own on debt funds. What are debt funds? Debt funds are basically mutual funds that will take your money and invest in bonds and debentures. Correct? Now, mutual fund advisors tell people that equity funds are the risky ones and debt funds are the safe ones. They are to some extent right. But I want you to think deep. Become Sandeep here. Imagine that Sandeep has purchased a debt mutual fund. And when Sandeep had purchased the debt mutual fund, all the different debentures that mutual fund is holding is having an average YTM of, let's say, 10.54%. And therefore the average price of everything that Sandeep owns is 980, for example. Students, is it possible that market interest rates rise? I gave you example of it falling from 10.54 to 9. Is it possible it rises from 10.54 to 12 or 13 in the market outside? Are you all understanding what I'm saying? If that happens, then what will happen to the market price of the bonds that Sandeep is holding? It will drop. I hope you are able to understand. It will drop. Correct? And Sandeep's mutual fund will go red. Come on everyone, are you able to understand? It will show negative return. And Sandeep will come running to me, sir, but you said debentures are safe, no? Students, do you realize you cannot escape volatility of market prices in debentures? Yeah, it might not be as volatile as how an equity share could be, because now the market interest rates don't fluctuate like this from 10.54 to 9 or 10.54 to 12. They fluctuate on the basis of something called as basis points. 1 basis point, 2 basis point, where 100 basis points is 1%. The fluctuation is 1 or 2 basis point, meaning 0.01%, 0.02%, like that it fluctuates. But that also can create gain or loss to people who have got huge holdings. You're understanding, no? But to explain academically, I'm just taking little extreme numbers from 10.54 straight to 12, from 10.54 to 9. Do you realize bond prices will also fluctuate? Come on, everybody clear? The mutual fund advisor who is not doing CA will tell the client, there is some demand supply problem. People are demand supply, what to do? But you should know yes, it is demand supply, but the demand supply is getting influenced because of changes in interest rates. Everyone clear? And when I'm saying changes in interest rates, I'm not talking of coupon rate of that particular bond. Listen carefully. Coupon rate of that bond is fixed. I am talking of overall people's required rate. Everyone clear now? Overall people's required rate of return. That becomes the YTM. YTM is nothing but required return of the majority. What the majority wants will become a reality. Are you all able to get what I'm trying to say? Now that you have understood this entire discussion, you come back to this question that we were doing. Students, this question that we were doing now, do you realize this particular bond is having a current market price of 110, and we figured out, if you want, just read now once, read the point number 1 of this question 11, point number 1, read please. Now after reading this, I want to tell you 110 is the current market price because majority people wanted 9.09% return. I hope you are able to understand. Now majority people are saying, hey, outside the interest rates are increasing, so now people are, the required return is now going to 10.09. Do you realize if the required return goes to 10.09, the bond prices have fallen? YTM increases, bond price falls. Am I making sense? It fell now from 100 rupees, from 110 rupees, it fell to 99.1. Okay. Now one last thing I want to tell you. Listen carefully. Mathematically you understood, na? Rate increased, present value fell. Logically, why is the bond price falling? A very deep explanation. Listen carefully. Logically, why is the bond price falling? It's simple. Look at me. I'll give you a very stupid example. You'll understand everything through it. Listen. Everyone ready? This is stupid, but you'll love it. Let's say you invest 1000 rupees somewhere and you say that you want 10% return. How much per annum do you want? 100? Correct, na? 1000 into 10% equal to 100. If you invest 2000 rupees somewhere and you say you want 10% return, how much per annum do you want? 200. If someone is giving you 100 rupees per annum and you want 10% return, do you realize you are ready to pay 1000 for this? Come on, everyone. Are you able to understand? You are ready to pay 1000. If someone is giving you 200 rupees per annum and you want 10%, then for that investment you are ready to pay 2000. Everyone clear? So can I say what you are ready to pay depends on two factors. It depends on the future cash flows and it depends on your required return. Am I making sense? This is what we had written at the start only. Valuation depends on two factors. Come on. We have written in the notebooks also. Correct? Now, let's take one out of these examples. Let's take this. Now I am saying someone is giving you 100 rupees every year. You are saying, sir, my investment should give me 10% return. Then for that 100 rupees, can I say you are ready to pay 1000, correct? Now I am saying that the person, the bond who is paying you a coupon of 100 is not going to change the coupon. Coupon is going to remain same only as 100 rupees. But your required return has changed because market is changing. For example, ready? Outside now everywhere people are getting 20%. So now you are saying from this bond also I want 20%. If from this bond also you want 20%, considering the fact that 100 rupees is not going to change, do you realize you are ready to pay only 500 for this bond? Come on, everyone. 100 divided by 20%, it is 500. Hello, are you able to understand? So can you see that as the YTM increases, correct, people will not then pay 1000 rupees for getting 100, na, because outside they are getting 20%. If here by paying 1000 we will get only 100 rupees, then people are getting only 10%. Why will anyone come to this bond then? Because if outside they're getting 20%, I hope you're getting it. The bond has to adjust itself accordingly so that investors get 20% here also. And for that to happen, the price has to fall. No, I hope you're getting it. The price has to fall. Coupon cannot increase. See, you cannot tell me like this that, sir, you cannot say that, sir, the bond should start giving me more coupons. No. The bond will give you same coupon. Coupon is fixed. That's the whole premise of being a debenture. The coupon is fixed. And if the coupon is fixed and the price is still 1000, can I say the YTM that you are getting in this bond is only 10%? Am I making sense? Will anyone come to this bond when outside market interest rates are 20%? Nobody will come. There will be zero demand for this particular bond. Everyone will say 1000 is too expensive. We will say, why expensive 1000? Just now though you are ready to pay 1000 rupees. So we will say we were ready for 1000 because at that time outside also opportunity cost was 10%. But now opportunity cost is 20%. Hello. So if opportunity cost is 20, can I say you want YTM of 20 now? You want YTM of 20, coupon is saying we will not change, then the only thing that gets affected is the price. Come on everyone, the only thing that gets affected is the price, and I hope you realize the price therefore will have to drop to 500. Everyone clear? Hello. Which means people like Sandeep here will try their best to sell the bond at 1000, but people like Tamanna will not buy it only. Am I making sense? People like Tamanna will not buy it. They will say Tamanna is now representing the entire majority buyer community. They are saying that because this bond is giving 100 rupees and because we want 20%, we are not willing to pay a rupee above 500. How I got 500 understood na? 100 divided by 20%. Everyone clear na? I am not ready to pay a rupee above 500. And I hope you realize 100 divided by 20% meaning this only na, interest divided by YTM, present value of future cash flow. Same concept. Tamanna here you are doing 100 divided by 20%. In a vanilla bond, you will make that table year, cash flow, discounting factor at the rate 20%, present value, and then you will calculate the present value and you will say this is what I am ready to maximum pay. That answer will be around 500 for example. You will not pay a rupee above 500 because here you want 20%. So can you see that as YTM, as market interest rates go up, are you understanding the non-mathematical logic of why the prices are falling? The prices are falling because no demand only will be there at 1000 rupees. Why there will be no demand at 1000 rupees? Because at 1000 rupees people will get only YTM of 10%. They want YTM of 20. So buyers will start only at 500 or below. Everyone clear na? 500 or below. 500 is a maximum. So sellers, you will have to come down. This is all economics what I taught you. From our finance and maths point of view, finance is basically a combination of maths and eco. You understand no? You understand in finance we are saying okay, as YTM, when people like Tamanna wanted 9.09%, Sandeep, the bond that you are holding is having a price of 110. But because market interest rates are now changing from 9.09 to 1%, people like Tamanna are now wanting 10.09% from your bond. Why will the bond then have a price of 110? No, they will not, because if Tamanna buys this bond at 110, she is not going to get different coupon. No, coupon will be 10 rupees only. So she will end up getting 9.09, whereas all her friends outside are getting 10.09. Why will Tamanna accept Why will Tamanna accept this particular bond? But then if Tamanna, who is representing the market, will not buy this bond, people like Sandeep will never be able to sell the bond. Sandeep wants to sell now. So do you realize the prices that Sandeep will offer to at which he has to sell has to drop down to 99.1. Everyone clear? Has to drop down to 99.1, which mathematically we are calculating by discounting future cash flows at the revised YTM. That's the only thing that we are doing in FM. We are simply saying take future cash flows, discount them at the rate YTM, whatever is the price, give marks. Correct? That is our goal. But I hope you got the background story of what is happening here. Okay, so I said I'll speak for 10 minutes, but I'm almost speaking for 40 minutes now. Ignore whatever I said. It's okay. You understood how to calculate now. That's enough. Okay, great. So students, this is point number 1 of this particular question. 2-line answer it was. Institute solution, if you see, it gets over in 1 or 2 lines only. Okay, but okay, whatever is necessary I gave you in writing also. Okay, please start. Krishna, not required, please. It become too much. Point one done. Such a person's point one was also done who always used to tell me to go slow. That means now everyone's point one must have 100% happened. No? So I can safely now go to the next slide. I will not reveal the name. Anytime I change slides, this person first messages go slow. Okay, all done. All right. So now I am wanting to see how you people tackle point number two. Let me tell you, very simple. It's all in front of you. Get me the market price of the bond number two. I am waiting. Start. Always remember all interest rates given, coupon or anything. Everything is annual basis. Huh? Remember that all interest rates given are always annual. You have to convert it. Okay, I am waiting. Start. Point number two. Do it in fair. You should be able to do it. It's a plain vanilla bond. Come on. All done. So what did you do? A bond with 7.5% coupon, face value 10,000. Okay, that means 750 rupees is annual coupon. Life is 2 years. YTM presently yielding means its YTM is 6%, and the interest actually now after 6% it is like a full stop, and then they are saying that the coupon is payable half yearly. How to find market price? Very simple. You will say point number 2, CMP is equal to in fact I'll just copy this from here and I will say not year, but I hope you remember, we will call it as period. Period cash inflow DF, I hope you took 3% present value. 4 periods, for each of the 4 periods you'll get 375 and you'll get 10,000 at the end. Discounting factor and all if you do, you will get the current market price as question number, as sorry, what question number, as how much? 9995 point, no, what is the answer? 10,278. Okay, 10,278, somewhere around this number, please. One divided by 1.03, 1, 2, 3, 4, 0.888, 3.717. These numbers are correct, please check. Oh sorry, it is 8,880. I took one number less. It is like this, no? Just check. 8,880. That's what I'm thinking. What happened? 1393.88 plus 8880. Yeah, 10273.88. 0273.88 is the answer. All done. Okay, so with that we complete question number 11. Now this was okay. Okay, we'll do 12th. Question number 12. 8 we'll do tomorrow. Question 12, last question for the day. Please read. The solution is smaller than the question. Really. On June 1, 2003, the financial manager of ABC Corporation's Pension Fund Trust is reviewing strategy regarding the fund. Over 60% of the fund is invested in fixed rate long-term bonds. Interest rates are expected to be quite volatile over the few years. Among the fund's current investments are two AA rated bonds. Students, the whole information is useless. Let's start reading the question again from here. There are two bonds. One is a ZCB and one is a plain vanilla with semi-annual coupon. One thing you should see, look at the screen. You are talking from 2003 to 2018, which means these are 15-year bonds. You're understanding, no? In 2003, we are saying that they will mature in 2018. So it's a 15-year bond. Hey, what is the meaning of current annual market interest rate? This is the YTM. Everyone clear? This is the rate at which you will be discounting. The effective semi-annual yield may be 3%. So this line also is useless. You're understanding? Because even if they don't tell you, we will take 3 only, no? Both the bonds have a par value and redemption value of 100. Listen to me carefully. They did not say that both bonds have market value and redemption value same. They did not say issue price is same as redemption value. They are simply saying redemption is at par. There is nothing else in this line. I hope you are understanding. This line also, if they wouldn't have given, was okay, because we would have anyways assumed the redemption at par. Everyone clear? Estimate the price of the bond at the current market interest rate. Okay, I will first of all do for ZCB. What is the question number? Question number 12. Point number 1. I'll say calculation of current market price. And in that point number 1, for zero coupon bond 2018. Okay, 2018 bracket 15-year bond. Now students, as far as current market price is concerned, CMP is present value of all future cash inflows, year cash inflow, discounting factor at the rate 6%, present value 15. Have they given to you the face value? Face value is not given, given 100 rupees. 100 rupees face value given. So do you realize that only will be the redemption value? Students, you are understanding what I am doing? In a zero coupon bond, only one cash flow is there. That is redemption value. There is nothing else. We have not done any sum earlier on this, but I had explained to this to you when we did point number D. Discounting factor. Okay, let's do it. 1 divided by 1.06. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15. 0.417, 41.7, and that itself is the current market price, that is 41.7. Everybody clear? Simple calculation, game over. Point number 2. Point number 2, what bond it is there? 12% gilt 2018. Now what is gilt? Students, gilt here refers to Government of India issued long-term securities. Basically it's a government security. Everybody clear, na? Government security. So here I will take 12% gilt 2018. So see what I am doing. Just give me 1 minute. Point number 2, for 12% gilt 2018. Students, everything remains same. Tell me, where will things change? Do you realize period will come instead of year? Why? Because they are saying that the interest is payable on semi-annual basis. So do you therefore realize that in this bond, for 30 30 periods you will get the coupon, and at the end of the 30th period you will get the redemption. It is 12%, meaning 6 rupees every year. Everyone clear now? 100 rupees. 100 rupees is the face value. 12% is the coupon. So 12 rupees is annual interest. Semi-annually means 6 rupees. And the required return which we have taken as 6, can I say instead of 6 we will take it as 3. Everyone clear now? Discounting rate annually was 6%, but for semi-annually we will take 3%. So we will take the calci and we will solve this. Everyone following now? Basic semi-annual calculation this is. All the best. But don't forget to first write the discounting factor of the 30th period. Otherwise a whole 30 you have to do again before you press GT. So 1 divided by 1.03. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 0.412 19.600. Someone please confirm this. Okay. People are blindly trusting me at 2 p.m. Sir, even if you write 39.3745, we will still accept. Okay. So 6 into 19.6. This is 117.6. This is what? 41.2. 158.8. 158.8. Done. 158.8. So students, no problem. We will write it down tomorrow. It is okay. Tomorrow also we have lecture, no? 6:30 a.m. Don't worry. We'll write it down tomorrow. Because tomorrow, no, when you come at 6:30, I am not very sure in what shape you will be. So just to warm you up, na, this question we'll do writing. Because tomorrow at 6:30, if I start new concept, oh, I'll start at 6:35. 5 minutes at least we'll go into all this. People are already telling bye to me on the chat box. What is this? Okay. Yeah, I'll do mutual fund PDF. Thank you. Today's lecture clear. Everyone following, give me yes on chat box and you can leave. I hope you're understanding bond valuation. Bye bye. Take care. धन्यवाद.